Here is the puzzle. One kind of company has quietly become a star of the AI boom, and one of the most shorted names in tech at the same time. It's called a neocloud. The idea is simple. Buy scarce AI accelerators in bulk, then rent that compute out to everyone who can't get the chips themselves. Think of it as a landlord for GPUs. When demand for AI compute runs far ahead of supply, that rental business can re-rate. Its valuation multiple expands as the market prices in scarcity. CoreWeave is the well-known example, and we'll use it purely as an illustrative lens for the mechanism, not as a forecast about any stock. So, why does renting GPUs re-rate so sharply? Walk the model. The neocloud signs long contracts to rent its accelerators, which turns borrowed depreciating hardware into visible recurring revenue. The market loves visible revenue, so when AI demand spikes and that revenue accelerates, the valuation multiple expands on top of it, price moving faster than the business itself. That's the re-rating. But notice the engine underneath. The chips were funded by heavy debt. So the very thing that makes the upside dramatic, leverage on a scarce, fast depreciating asset, is also what makes the downside dramatic if demand or financing turns. Now the other side, because this is a map, not a cheerleading session. The bears are stacked, and here is their case. First, the customers can be concentrated. A lot of the contracted revenue may lean on just a few large buyers, so losing one would hurt. Second, the build-out is debt-funded, and debt has to be serviced whether or not the AI capex cycle stays hot. Third, GPUs depreciate fast, so today's scarce premium asset can become tomorrow's commodity. Put those together, and you get heavy short interest. A large share of the float betting the re-rate unwinds. High conviction on both sides is exactly what makes the swing so violent. So how does this play out across the picture? Read it as a map, not a verdict. AI compute demand can keep booming, which is the whole bull case. Scarce capacity rented at a premium. Customer concentration sits on the other side as a real risk, since a few big contracts carry a lot of the weight. The debt load both funds the build-out and raises the stakes, because leverage cuts both ways. And volatility tends to run high, precisely because bulls and bears are both crowded into the same name. One rental model, refracted by which risk you weight most. So go back to the opening puzzle. How can a company be the backbone of the AI boom and a debt-funded bubble on the same chart? The lesson is this. Renting a scarce thing is a wonderful business while it stays scarce. Visible revenue, pricing power, a fast re-rate. But the engine runs on leverage and on a handful of customers. So the same model that prints revenue can reverse hard if the rent softens or the debt comes due. That's why both stories ride the same stock at once. The mechanism doesn't tell you which side wins. It tells you what to watch. This is an explainer, not advice. Verify the specifics yourself. Renting the scarce thing prints revenue until the rent or the debt turns.